Welcome back to the Deep Dive. We're here again to sift through that mountain of market reports, analyst notes, all those conflicting forecasts you've sent us, and really boil it down.
Yeah, find the signal in the noise.
Exactly. Because if you've been watching the charts this week, especially after the FOMC decision, well, things are messy. That's putting it mildly.
Totally. The confusion it's really palpable, isn't it?
It is. The market's getting yanked around, and if you're trying to manage risk or figure out your long-term position right now, yeah, you're probably feeling a bit lost in it all.
And that's why we're here today. Our mission, really, is to cut through all that, the FUD, the sudden bursts of hope, and answer a key question for you.
Which is?
Are these recent moves, these bounces, just short-term relief rallies, fueled by a bit of leverage, a bit of hope? Or are they actually signaling something bigger, like a real shift in the underlying cycle?
Because we've got data pulling both ways, right? Like really bearish trading signals sitting right next to some pretty bullish long-term fundamental news.
Precisely. It's a contradiction, and we need to unpack all of it.
Okay, let's dive in with the immediate action then, because that's where a lot of the anxiety seems to be focused. Bitcoin retested $106,000 yesterday.
Yep, that was a bit scary for a lot of people.
Definitely surprised. But then, buyers jumped in, pushed it back up towards $111,000 today. So that immediate question on everyone's mind, does that bounce stick? Is it real?
Unfortunately, the sources we've reviewed, they're sounding a pretty loud alarm bell here.
Oh.
Yeah, the analysis really suggests this push to 111K is likely not a sustainable foundation, not for a long-term recovery anyway.
Okay, let's unpack that skepticism. I mean, a $5,000 bounce, that seems pretty strong on the surface. Why the doubt? How can we tell if it's synthetic?
It's about where the demand is coming from. And this move, it looks heavily leverage-driven.
Leverage-driven.
Meaning it's mostly being fueled by perpetual contracts. For you listening, think of perpetuals or perps as futures contracts, but crucially, without an expiry date.
Right. So they let traders take big bets, often with a lot of borrowed money, very quickly.
Exactly. It's speculative activity. It's not long-term, confident buying. And when the price gets pushed mainly by leverage like this, well, the correction, if it comes, tends to be pretty sharp. Painful.
Okay. So if the leverage is up, where's the real demand, the grounded buying?
That's the worrying part. The indicators we look at for genuine institutional demand, they're actually falling.
Like which ones?
The Coinbase premium indicator, for one, it's a great way to gauge U.S. institutional interest, and it's dropping again.
Then a falling premium means?
It tells us U.S. institutions aren't buying as aggressively compared to, say, international exchanges. And maybe even worse, we have specific reports showing ETF flows have turned negative.
Oof. Negative ETF flows are never good.
No. And it's specific to BlackRock's ETF, some of the biggest ones, are reportedly sending both Bitcoin and Ethereum to Coinbase specifically to be sold.
Wow. Okay, that's not ambiguous. That's institutions actively reducing risk.
Crystal clear signal. Yeah. Selling pressure.
And then there's the macro picture hanging over everything. The strong dollar is still a huge drag on risk assets, right?
Absolutely. A major headwind. But what also popped up in the source material, which was a bit surprising, was renewed geopolitical tension.
Oh, yeah. Like what?
Specifically, the risk of increased U.S. conflict involving Venezuela was cited.
Huh. Venezuela. Why does that matter for crypto specifically? Seems a bit random.
Because any kind of geopolitical uncertainty, especially involving major powers, tends to accelerate de-risking across the board.
Right. Institutions get nervous, pull back from anything volatile.
Exactly. So funds reduce exposure to assets they see as risky, and that definitely includes Bitcoin right now. It just adds another layer of potential selling pressure. Makes it more likely that 106K support might not hold if we test it again.
Okay, so if $106,000 does break, what's the next level down people should be watching?
The next key support zone the sources are highlighting is around $102,000.
102K.
Got it. But crucially, the forecast isn't really for a sudden crash, like a straight line down. It's more likely to be a choppy downtrend.
Choppy downtrend, meaning?
Take a slow grind lower over the coming weeks. But it'll likely be punctuated by these deceptive little rallies.
Yeah.
Like the one we just saw.
Okay, this brings us to something really interesting and, frankly, a bit cynical that came up in the trading reports. People are calling these short-term spikes exit pumps.
Yes, that term is being used a lot right now.
We need to break that down. For anyone trying to trade this, what exactly is an exit pump? How can you spot one?
Right, an exit pump is basically a market manipulation tactic. It's classic, usually used by big players, insiders, whales, whatever you want to call them.
The ones with large positions to unload?
Precisely. They want to sell off big chunks without tanking the price while they're still selling. The source material actually lays out a pretty clear, like, 4-step playbook. It's very useful to understand.
Okay, walk us through it, step by step.
First, the insiders use their capital, their buying power, to artificially pump the price up
To
quickly.
create some FOMO.
Exactly. The goal is to generate buzz, excitement, make it look like a recovery is starting. This draws in new buyers, often retail traders, who see the green candles and panic buy, thinking they'll miss out.
Okay, step 2.
Step 2, that rush of new buying, that retail panic, dramatically increases the liquidity. There are suddenly way more buy orders on the books.
So more people willing to buy at those higher prices.
Yep. Step 3,
Yeah.
the insiders take advantage of that. They use that fresh liquidity, those eager retail buyers, as exit liquidity. They start selling their own large positions quietly into that demand they just helped create.
Wow, so they engineer their own selling opportunity at inflated prices.
That's the essence of it. And then, step 4, once those large players have offloaded enough of their holdings, the artificial buying pressure they created just vanishes.
All the rug?
Basically, the retail buyers who chase the pump are left holding assets at high prices, and the price drops sharply, often back below where the pump even started.
Ouch. That's a tough lesson in market mechanics. Were there specific examples mentioned?
Yeah, the source material pointed out this mechanism is already being seen, particularly in some smaller altcoins. It specifically mentioned a token called I-16s
Yeah.
as showing signs of this kind of orchestrated exit.
I-16s.
Okay, so the key takeaway for you, the listener, is just to be really vigilant. If you see these sudden sharp pumps in smaller coins, especially ones without any obvious major news driving them, treat that with extreme suspicion.
Right. It might not be your entry point. It might be someone else's exit ramp.
Couldn't have said it better myself.
Okay, so short term. Bearish, leveraged, watch out for exit pumps. Got it. Let's zoom out now. Let's talk about the bigger picture, the cycle itself. We looked at Benjamin Cowan's analysis.
Yeah, from October 31st, really relevant given the Fed's latest moves.
Exactly. He's tackling that huge question. Could the cycle top actually already be in?
Yeah.
Or very close?
It ties the immediate price action we're seeing to the big macro drivers. Cowan focuses on what the Fed just did, that rate cut down to 4%, and their plan to end quantitative tightening QT by December.
Okay, let's clarify those. Normally you hear rate cut and ending QT and people think bullish, more liquidity coming or at least less being removed. What exactly is QT again?
Right. So quantitative tightening, QT, is the Fed shrinking its balance sheet, basically sucking money out of the financial system. Ending QT means they stop sucking money out. Cutting rates obviously makes borrowing cheaper. So yeah, usually bullish signals.
But Cowan's cautious. Why?
His argument hinges on the context. He sees these moves not as the Fed panicking in a crisis, but more as risk management, trying to fine-tune things, avoid major turbulence maybe, but not reacting to a 5-alarm fire.
And the difference matters because
if the Fed is just easing off the brakes slightly versus slamming the accelerator in an emergency, the market reaction, the resulting euphoria, tends to be much more muted, less rocket fuel for risk assets like Bitcoin.
that makes sense. It's about the reason for the easing, not just the easing itself. And didn't he draw a parallel to a previous cycle?
He did, a really important one. Back in 2019, he points out that Bitcoin actually topped out before the Fed officially ended QT that year.
So ending QT didn't guarantee more upside, then?
Exactly.
Mm.
It suggests that just because the Fed is stopping QT now and cutting rates slightly, it doesn't automatically mean Bitcoin is destined for new highs, even though it adds liquidity. History suggests otherwise, or at least adds a big asterisk.
So the timing becomes critical. What's his key constraint? What should we be watching for to gauge if this cycle really is topping out?
His point is pretty sharp. If Bitcoin doesn't manage to break out and make new all-time highs relatively soon, like if it doesn't convincingly push higher by maybe December when QT ends, then it strongly suggests this cycle top might already be in or very, very close.
And his forecast for where that top might land.
He's looking at Q4 of this year, 2025, as the potential final peak. And the range he mentioned was around $130,000 to $140,000.
130K to 140K. Compared to some of the wild predictions we heard last cycle, that almost sounds underwhelming.
It does. And that ties directly into the other crucial point he makes, the lack of euphoria this time around.
Right. Explain that.
Compared to the peaks in, say, 2013, 2017, or even 2021, we're just not seeing that widespread retail mania.
Yeah.
Your neighbor isn't asking you about Bitcoin at dinner parties. There isn't that feeling of irrational runaway excitement.
It feels more institutional, maybe a bit more sober this time.
Perhaps. And because that kind of wild euphoria is missing, Cowen warns this cycle might not end with a bang. Not with that dramatic, parabolic blow-off top everyone expects based on history. Instead, it could just fizzle out.
Fizzle out.
Yeah. Slower, more quietly, as he put it. Just sort of peter out without the massive fireworks, a silent peak.
Okay, that paints a really interesting kind of subdued macro picture. Short-term chop, bearish signals, potential exit pumps, layered on top of a possible quiet cycle peak looming. Let's switch gears, though.
Right, because despite all that fear in the trading pits,
the builders are still building. Developers, institutions, they seem completely undeterred. How do we square that circle? Why build infrastructure for a $2 trillion market if the cycle's about to top out?
That is the million-dollar question, isn't it? Or maybe the $2 trillion question. This is where the long-term fundamental case really pushes back hard against the short-term price worries. The commitment is undeniable.
Okay, give us the highlights. What are the key development points we need to know?
Okay, first up, Ethereum's moving fast. The Fusaka upgrade, it's officially locked in for December 3rd.
And Fusaka is big because
it's focused on major scalability improvements, making the network faster and cheaper, plus boosting validator efficiency. It's basically laying more groundwork for handling much higher transaction volumes. Foundational stuff.
Gotcha. And the institutional projections.
Huge. Standard Chartered came out with a prediction. They see real-world asset tokenization. Think stocks, bonds, real estate on the blockchain hitting $2 trillion by 2028.
$2 trillion. Wow.
Yeah. And crucially, they expect most of that activity to happen on Ethereum. That's a massive multi-year bet on the ecosystem, totally independent of today's price action.
And we're seeing shifts even in the stablecoin world, right? Which is kind of the bedrock for institutional activity.
Absolutely. JP Morgan highlighted something important. Circle's USDC is growing faster than Tether's USDT now.
Why is that significant?
JPM explicitly links it to USDC having stronger regulatory clarity and rising demand from institutions. It suggests the big financial players prefer the regulated, audited stablecoins for building their future infrastructure. It's not about trading swings. It's about trust and compliance.
Even companies like Strategy, who hold a ton of Bitcoin, they reported lower profits in Q3 because the rally cooled off.
Right. Their Q3 profit dropped to $2.8 billion. But what did they do? They actually raised their dividend yield.
To keep shareholders happy despite the lower profit.
Exactly. It signals they're still committed for the long haul, focusing on shareholder value beyond just the immediate BTC price. They're ignoring the chop, playing the long game.
It's fascinating. Traders are sweating exit pumps. Analysts are debating a quiet top. But financial giants are mapping out a $2 trillion future on these networks.
It's a major disconnect. They're clearly looking way past Q4 2025.
Okay, let's touch on one more area that's seen a surprising rally recently. Privacy coins. Coin Bureau put out analysis arguing they're more relevant than ever. Why now? Why the sudden interest when everything else is so focused on leverage and the Fed?
Coin Bureau's core argument is pretty fundamental. It boils down to this. Real-world financial activity, especially as more of it moves on-chain, needs confidentiality.
Privacy isn't just for illicit stuff. It's necessary for legitimate business.
Absolutely. Blockchains are transparent by design, which is great for auditing, but terrible if you're trying to run a business or manage personal finances without broadcasting everything to the world. That need for protection from surveillance is driving renewed interest.
And Coin Bureau ranked the main players, right? How do they stack up?
They do. Monero XMR is consistently called the gold standard.
Why gold standard?
Because its privacy features are on by default for every transaction, and it has a really decentralized mining setup. Privacy is baked in, not an afterthought.
Okay. Then there's Zcash.
Zcash, ZC, uses really advanced cryptography, zero-knowledge proofs, specifically ZK snarks.
ZK snarks. Okay, quick layman's terms. What do they let you do?
Basically, ZK snarks let you prove something is true, like, say, you have enough money in your account to make a payment without revealing any of the underlying details, like your total balance or the exact amount you're sending.
Powerful stuff. But there's a catch with Zcash.
Yeah, two main ones. Its privacy is opt-in, meaning you have to actively choose to make a shielded transaction. Many people just don't. And a lot of exchanges don't support those shielded transactions anyway, which limits its usability.
Makes sense. And what about Dash? It used to be talked about for privacy.
Yeah, Dash is often misunderstood now. They've kind of downplayed the privacy angle over the years. Their main feature is private send, which is essentially just a coin mixing service. It offers some obfuscation, but it's nowhere near the cryptographic privacy level of Monero or Zcash's shielded transactions.
So we have rising demand for this tech, but at the same time, regulators are getting nervous, right?
Hugely nervous. That's the big contradiction here. You've got the EU proposing bans on certain privacy tools, potentially by 2027. Exchanges are already feeling the pressure and delisting some of these coins.
Like Binance did with Monero in some regions.
Exactly. So regulators are pushing back hard. But the recent price action, the arguments from Coin Bureau, they show that user demand for actual on-chain confidentiality is increasing, not decreasing. It's a direct clash.
Regulation versus technological demand. A classic crypto story.
It really is. And it's a major friction point. Are regulators going to successfully push these tools underground, or will the sheer need for financial privacy force them to find ways to accommodate it? Maybe through technologies like ZK snarks that can potentially offer compliance options? That tension is why this space is suddenly hot again.
Okay, we've covered a ton of ground. It's a really conflicting picture. Short-term fear, leverage games, long-term institutional building, a possible quiet cycle top. Let's try and synthesize this.
Right. So the immediate market driver seems to be this short-term speculative leverage, those exit pumps we talked about, coupled with clear institutional de-risking, like the negative ETF flows. That's the surface chop.
But underneath,
the fundamental building is just relentless. Ethereum's Sasaka upgrade, the huge $2 trillion tokenization forecasts, that's the long-term foundation being laid. And the macro picture, with the Fed easing slightly but maybe not enough for real euphoria, supports Cowen's idea of a more muted cycle top, maybe around 130K, 140K.
So what does this all mean for you listening right now? The immediate game seems to be all about risk management.
Absolutely. It's about developing that skill to tell the difference between a speculative, leverage-fueled pop and real sustained demand.
How do you do that?
You watch indicators like that Coinbase Premium for signs of real institutional buying. You stay hyper-aware of the patterns that signal an exit pump, especially in smaller caps. And you probably need to be more cautious if this cycle really is going to fizzle out quietly without that obvious manic peak we saw before.
Vigilance is key then. If the top is subtle, you need to be disciplined.
Discipline and risk management are paramount right now. It's the only way to navigate this kind of environment successfully.
Excellent summary. We talked about the lack of euphoria suggesting a different kind of cycle ending, and we just discussed the clash between privacy regulation, like the EU ban talk, and the demand for tools like ZK snarks. So here's a final thought I want to leave you with. If regulators do succeed in pushing coins like Monero and Zcash off the major regulated exchanges, could that actually backfire? Could the persistent demand for true on-chain confidentiality just push users away from those regulated platforms entirely? Could it accelerate a shift towards more decentralized, perhaps even harder to regulate, trading environments? It poses a huge question about where technology and regulation ultimately collide.